Europe to take primary responsibility for their own energy security. In theory, a U.S. withdrawal or a finish the job mentality should signal the endgame of a conflict. However, the market has interpreted this not as a sign of peace, but as a vacuum of stability. When the world's primary guarantor of maritime security hints at stepping back, the risk premium on oil doesn't vanish, it migrates. Investors are betting that without a dominant stabilizing force, the Strait of Hormuz remains a bottleneck of volatility. Why the Strait of Hormuz still haunts markets? The strait is arguably the most vital 21-mile stretch of water on the planet. Through it flows roughly 20 million barrels per day, about 20% of global oil consumption. The current price rebound is fueled by three critical factors that exit talk has failed to address. The insurance crisis. Even if military strikes cease, shipping companies face astronomical war risk insurance premiums. Many major carriers, including Maersk and Hapag-Lloyd, have already rerouted or suspended transits. A diplomatic exit doesn't instantly lower the cost of moving a barrel of oil through a contested zone. Force majeure declarations. From Iraq to Kuwait, major producers have declared force majeure on contracts because they literally cannot move their product out of the Persian Gulf. As of late March 2026, Gulf oil exports have plummeted by an estimated 60%, dropping from 25 million to roughly 10 million barrels per day. The infrastructure lag. Reports indicate that even if the strait opened tomorrow, the damage to port infrastructure in places like Bahrain and the disruption of shipping schedules would take months to normalize. The geopolitical disconnect. President Trump's recent assertions that the U.S. does not need the Strait of Hormuz due to domestic production, which is on track to rise by 2.4 million barrels per day in 2026, are factually grounded in terms of U.S. energy independence. But it ignores the interconnectedness of global pricing. Oil is a fungible global commodity. If Asian refineries, which rely on the Middle East for 60 to 80% of their crude, cannot get their supply, they will bid up the price of Brent and WTI from other sources. This bidding war is exactly what is driving the current price rebound. While the U.S. might not need the oil from the strait, its economy is still highly sensitive to the price set by global scarcity. Oil prices dropped after the remarks by Donald Trump that raised hopes of potential U.S. exit from the Iran conflict. The markets soon discounted that tensions would subside and supply risks would fall, but that hope was soon lost. The situation on the ground is not improving. Traders are now reassessing whether the conflict is near the end. Therefore, the oil prices are rebounding as the risks return to the market. Oil drops on exit hopes, but market questions the reality. The oil prices dropped as traders responded to news that the United States might withdraw from the conflict. The oil market interpreted this news as a potential turning point that could reduce geopolitical risk. Therefore, oil prices dropped on lower risk. This decline in oil prices reflected positioning rather than real improvement in supply conditions, as the Strait of Hormuz was still closed. However, market quickly realized that the comments alone do not resolve the ongoing geopolitical conflict. There was no agreement to secure energy flows. The structural resolution has not yet been met, which keeps the risks elevated. Therefore, the initial drop in prices looks more like a short-term reaction rather than a shift in the broader trend. Supply risks keep oil supported despite exit signals. The Strait of Hormuz processes 20% of the world's energy and is now the biggest problem for the global economy. If the U.S. withdraws its participation in the war, it is not certain that shipping routes to the Middle East will reopen. This situation keeps the uncertainty high in the energy market. The continued attacks on energy infrastructure keep the risk premium alive in the oil markets. Thus, oil prices surged again on Thursday following decline on Wednesday. Moreover, the end of the war does not resolve the supply shortages globally in March 2026. The long-term effects of these disruptions on the global economy are huge. The effects will probably be experienced in the coming few weeks. This will likely have the greatest effect on the European economy. If tensions remain prolonged, the flows could tighten the market further. This situation may keep oil prices elevated even if the U.S. exits Iran. WTI crude oil technical analysis. The monthly chart for WTI crude oil shows that prices surged in March and hit strong resistance of $119.48 that was defined by the resistance of a descending channel.